I want you to take a moment and think about the foundational principle of your retirement strategy, the core tenet of modern financial planning that has been drilled into us for the last 3 decades. It is the idea that diversification, automation, and low-cost structure are the ultimate shields against market volatility. I am, of course, talking about the index fund. What if I told you that this very tool, this widely accepted bedrock of safety and efficiency, the passive investment vehicle that has captured trillions of dollars in global capital, is not merely exposed to risk, but is, in fact, the single greatest source of systemic instability facing the average investor today? This is not hyperbole designed to capture your attention. This is a deeply structural, mathematically verifiable truth that has been largely ignored in the pursuit of marginal gains and managerial simplicity. For years, we have operated under the assumption that index funds are the smart money's answer to active management failure. We were told, rightly, that most fund managers fail to beat the benchmark, and that the high fees they charge erode long-term compounding. The solution seemed elegant, irrefutable, and indeed revolutionary. Just buy the entire market cheaply, hold it, and let the rising tide lift all boats. Trillions flowed into Vanguard, BlackRock, State Street, and similar passive mandates. This tidal wave of capital was heralded as the democratization of finance, ensuring that every small investor could participate in the market's broad, reliable ascent. But we missed something critical in our rush toward efficiency. We overlooked the fact that liquidity is a fragile illusion, and structural integrity is often sacrificed at the altar of convenience. We failed to recognize that by collectively agreeing to invest exactly the same way, we were not diversifying risk. We were synchronizing it. We were building a colossal market edifice where every pillar was resting on the same handful of foundation stones, and every emergency exit was precisely the same size, regardless of the crowd trying to rush through it. The danger of index funds, as I have been warning for some time, is twofold. It destroys legitimate price discovery, and it guarantees a horrifying concentration of risk that is entirely invisible to the typical investor. Let us dissect the phenomenon of price discovery first, because this is where the market's intelligence truly degrades. Index funds, by their nature, are blind buyers. Their mandate is not to assess the value of Apple, Microsoft, or Amazon. Their mandate is simply to own the weight of these stocks relative to their market capitalization within the specified index, be it the S&P 500, the Russell 2000, or the MSCI World. If Microsoft's price goes up, its market capitalization increases, and therefore the index fund is mandated to buy more of it, regardless of whether the company is fundamentally overvalued, fairly valued, or experiencing internal decline. Think about the implications of this mechanical buying. When does an index fund stop buying a ridiculously priced stock? Only when it falls out of the index, or when the overall flow of capital into the fund ceases or reverses. This mechanism disconnects the share price entirely from the underlying economics of the business. It means that the biggest, most popular companies are continuously reinforced by passive capital, creating an automatic bid that supports valuations far beyond what any rigorous active capital allocator would justify. This doesn't just inflate specific sectors. It starves the rest of the market of the capital needed for genuine innovation and growth. Money flows to the top 5 largest companies, not because they are inherently the best investment for the next 10 years, but simply because they were the best investment for the last 10 years, and they currently command the largest market cap. It is a dangerous, self-fulfilling prophecy, where size begets mandatory capital inflows, which begets more size, until the valuation bubble becomes so structurally inflated that it cannot support itself without perpetual passive feeding. Now let us turn to the second, more immediate systemic risk: homogeneity. The index fund investor believes they are diversified because they own 500 different companies in the S&P 500. This is the great illusion. While they may own 500 tickers, the reality is that the performance of their fund is overwhelmingly dictated by the top 5 to 10 holdings. Currently, the concentration in the largest index funds is historic. The performance of the S&P 500 is overwhelmingly driven by the Magnificent Seven. This means that a retired couple relying on their index fund for income, a pension fund managing trillions, and a young professional just starting their portfolio are all, in essence, making the exact same concentrated bet. They own the same stocks, in roughly the same proportion, and they are all susceptible to the exact same idiosyncratic risks facing those specific corporations and sectors. True diversification, the practice of owning assets that perform differently under different economic regimes, has been utterly abandoned by the passive movement. We have all rushed to the same side of the boat, convinced that we are the only ones there. The real danger emerges when we introduce stress into this hyper-homogenized system. The index fund is a beautiful invention during a decade-long bull market fueled by quantitative easing and low rates. It performs flawlessly when the trend is your friend, but markets do not trend upwards indefinitely. They are cyclical, volatile, and prone to panic. What happens when panic strikes? This is where the structure of the exchange-traded fund, the ETF, reveals its potentially catastrophic flaw. When investors decide they want out of their index fund, they redeem their shares. The ETF manager, obligated to track the underlying index, cannot simply hold cash and wait for a better buying opportunity. They are mandated sellers. When redemptions hit, they must liquidate the underlying securities to raise the cash needed to meet those redemptions. And crucially, they must liquidate those holdings proportionally. If the market suddenly drops 10%, triggering widespread fear and mass redemptions, the index fund is forced to sell the very stocks that everyone else is selling, magnifying the decline. Furthermore, because of the concentration bias we discussed, they sell disproportionately those large, already stressed mega-cap stocks. This is the key difference between active and passive selling in a crisis. An active manager sees a rapidly dropping stock, assesses the fundamentals, and might step in as a contrarian buyer, providing support or at least strategically pausing their sales. They use intelligence and discretion. The index fund manager, however, is robotically blind. They must sell regardless of price, regardless of valuation, and regardless of fundamental merits, simply because the mandate requires them to track the index and meet the redemption demand. This transforms market panic from a localized, sector-specific event into a systemic, amplified feedback loop. The selling is automatic, simultaneous, and concentrated in the largest, most widely held assets. In a real downturn, a sustained bear market driven by fundamental economic shifts, not just a brief correction, this process could easily accelerate declines to a speed and magnitude we have not witnessed since the automated trading began dominating the landscape. We must understand that index funds have fundamentally changed market liquidity, and not for the better. We have the illusion of liquidity because we can easily buy and sell the ETF shares themselves on the stock exchange. We see the bid-ask spread and assume the underlying assets are just as easy to liquidate. This is a profound misunderstanding of market mechanics. The trading of the ETF shares, the paper liquidity, is vast. But the underlying market for the actual massive blocks of Microsoft, Apple, and Amazon that the ETF issuer holds is thin, volatile, and deeply sensitive to mass liquidation. In a rush for the exits, the ETF's market price might diverge violently from the net asset value (NAV) of its holdings. Authorized participants, APs, who are supposed to arbitrage this difference and keep the price in line, may find themselves unable or unwilling to step in and buy billions of dollars of falling shares in a deeply stressed market. Why? Because the index fund itself has eliminated the natural buyers of last resort, the intelligent, patient, long-term capital allocators. The biggest danger inherent in the passive model is precisely its celebrated efficiency, the elimination of discretion. When everyone is mandated to hold the same things, who is left to buy when everyone is mandated to sell? The answer, disturbingly, is often nobody. The buyers disappear, liquidity freezes, and the gap between the ETF price and the underlying asset value widens, creating further stress and forcing more liquidation. This is how the system implodes, not through nefarious intent, but through structural design flaws built into the very mechanism intended to safeguard retirement capital. This structural vulnerability leads to a profound erosion of capital discipline across the entire market ecosystem. When investors know that passive money will automatically bid up the price of the largest companies, there is less incentive for corporate management to focus on strict capital efficiency or return on equity. They can pursue risky expansion, take on more debt, or engage in questionable acquisitions, knowing that the river of passive capital will keep flowing regardless of fundamental oversight. This complacency is pervasive, fostering an environment where misallocation of capital becomes the norm, only to be exposed with brutal efficiency when the passive flow eventually reverses. It is crucial to recognize that the index fund is not just an investment vehicle. It is an economic force that molds and distorts the entire marketplace. It is a mechanism for concentration, not diversification. It is a guarantee of synchronized behavior, not independent thinking. And most importantly, it represents a monumental test of the theory that complexity can be made safe simply by lowering the fee structure. The warning here is clear, and it is urgent. We have reached a point of maximum structural risk coupled with maximum investor complacency. We are living through a market environment where performance has masked deep, underlying instability. People look at their portfolios, see the gains of the past few years, and attribute their success to the prudence of passive investing. But those gains were driven by the structural inflation of the largest market segments, reinforced by a decade of extraordinary monetary policy. The true test of safety is not how an investment performs when everything is going well. The test is how it performs when the foundational assumptions of the market, low rates, continuous easy money, and stable passive inflows, begin to crumble. The index fund, under sustained stress, becomes a guaranteed amplifier of downside volatility, forcing the selling of the most concentrated assets at precisely the worst possible moment. The narrative of safety surrounding these vehicles is a dangerous delusion. It is a belief system that has compelled trillions of dollars into a structural trap. A trap built not by poor stock picking, but by the very mathematics of the mandate itself. Therefore, the critical question for every prudent investor right now is this: if the core engine of market safety, the index fund, is instead the fuse to a systemic bomb, where do you position your capital? Where are the assets that stand outside this homogeneity? Where is the capital that actually benefits from true scarcity and structural independence? We need to completely rethink what safety means. Safety is no longer found in maximum diversification across the market's largest capitalization segments. Safety is now found in assets that possess genuine scarcity, that exhibit contrarian correlation, and that are entirely disconnected from the mechanical, algorithm-driven buying and selling mandates of the passive trillion-dollar titans. This demands a severe departure from conventional wisdom and a focused, disciplined pivot toward assets that have traditionally acted as genuine safe harbors during periods of structural market collapse and economic uncertainty. We must look beyond the noise of the mainstream indices and identify those areas of the market where true, uninflated value remains and where independent capital can provide the critical stability that passive mandates cannot. The time for complacency is over. The warning signs are systemic, flashing across the market structure itself. In the next part, we will move beyond the problem and delve into the actionable solutions. We will explore the specific investment strategies and asset classes that Sprott-style investing advocates, those that offer true portfolio insulation, that thrive on market structural failure, and that provide the necessary sanctuary when the vast, passive market inevitably faces its reckoning. Prepare to restructure your entire approach to capital preservation. This isn't just about market cycles anymore. This isn't the predictable ebb and flow of capital that we have been taught to expect since the end of the Second World War. What we are discussing now, the core warning that needs to be absorbed by every single investor reliant on the seeming simplicity of index funds, is a structural failure of market physics itself. The first part laid the groundwork, showing how these passive vehicles, these towering behemoths of indiscriminate buying, have distorted valuations and concentrated risk into a few central hubs. Now, we must confront the inevitable consequence. The moment the first domino falls, and the perceived safety of diversification transforms instantaneously into an inescapable liquidity trap. The hook that must grab you and refuse to let go is this: you believe your index fund is backed by a diverse basket of highly traded stocks, offering immediate liquidity. But when everyone rushes for the exit at the same time, the liquidity you demand simply evaporates, because the market has already been stripped bare of genuine, price-sensitive buyers. The market structure is now entirely predicated on the continuation of flow into passive vehicles. The moment that flow reverses, the whole system seizes up. Let's expand on this critical concept of market seizure. When a traditional active manager decides to sell a position, they sell it because the fundamentals have deteriorated, or they see a better opportunity elsewhere. The transaction requires a willing buyer who believes the asset is undervalued or fairly priced. This dynamic ensures price discovery remains relatively healthy, even during corrections. But that mechanism, that organic balance, has been obliterated by the ascendancy of the index fund. When an index fund experiences redemptions, especially during a crisis, they are not selling because of fundamentals. They are selling mandatorily. They must maintain their allocation weights. If investors pull $1 billion out of the S&P 500 ETF, the ETF must sell a slice of every single stock in the index, regardless of whether that stock is trading at 2 times earnings or 20 times earnings. There is no discretion, no analysis, just mechanical divestment. Who precisely is going to buy that massive mandated sell order? The vast majority of capital inflows over the last 15 years have gone into these same passive products. The active managers who used to stand ready to scoop up value when others panicked have been systematically underfunded, marginalized, or driven out of business by the relentless march of passive returns. They are not waiting on the sidelines with trillions of dollars ready to catch a falling knife that is being thrown by an unthinking algorithm. This is the central conflict. Index funds have created a market where the sellers are massive, mandatory, and price-insensitive, while the potential buyers, the genuine fundamentalists, are small, cautious, and overwhelmed. The liquidity problem is not hypothetical. It's mathematical. Imagine a mid-cap stock that constitutes a small but necessary fraction of a major index. Passive vehicles collectively own 60 to 70% of the freely traded float of that company. In a major correction, say a 30% decline across the board, the index fund is forced to liquidate perhaps 10% of its holdings to meet redemptions. Where is the volume to absorb 60% of a mid-cap company's daily trading volume hitting the market simultaneously? The answer is nowhere. The price doesn't adjust. It simply collapses into a vacuum. The transaction simply cannot be executed at anything near the last traded price. This leads to the open loops, the terrifying unknowns that keep me up at night. What happens when the underlying illiquidity of the index fund assets translates directly into a crisis of confidence in the index fund shares themselves? The system is currently protected by the authorized participant (AP) mechanism, which is supposed to ensure that ETF shares trade near their net asset value (NAV). The APs are the designated market makers responsible for creating and redeeming ETF shares, bridging the paper ETF world with the underlying stock world. But the APs are not infinite pools of capital. They are banks and trading houses. If they see a tidal wave of selling coming, if they recognize that the underlying market for the stocks, particularly those less liquid mid and small caps, is evaporating, they will not risk their balance sheets to maintain the arbitrage. They will step back. When the APs retreat, the index funds, the ETFs, cease to trade near their NAV. Suddenly, the ETF unit itself, which you thought was a liquid proxy for the market, begins to trade at a severe discount. This is the re-engagement point, the moment of acute psychological pain where investors realize they aren't just losing money on the stocks. They are losing money on the vehicle they chose for safety. The diversified investment, the cornerstone of modern retirement planning, becomes the absolute center of market distress. The true climax of this structural failure is realizing that index funds are the ultimate expression of the financialization of everything. They represent paper claims on real assets, bundled together and traded based on perceived current value. When the underlying value collapses due to lack of tradability, the paper claims become nearly worthless placeholders. This isn't just about equities. The index phenomenon and the ensuing liquidity collapse is even more terrifying in the bond market. Corporate bond ETFs have exploded in popularity, offering retail investors the ease of stock trading combined with the perceived safety of debt. But the underlying corporate bond market is notoriously illiquid. primarily trading over the counter between large institutions. When you sell your corporate bond ETF unit, the fund has to sell individual bonds. Try selling a tranche of long-dated, non-investment grade corporate debt during a panic. There are no electronic exchanges with immediate matching. There is no bid. The attempt to liquidate billions in bonds to satisfy ETF redemptions will immediately freeze the entire corporate credit market. This is where the panic will metastasize from equities into the real economy. Companies relying on rolling over that debt will suddenly find the tap shut off. The passive investing trend has created an inherent positive feedback loop in the bull market. Money flows in, prices go up, attracting more money. But feedback loops cut both ways. In a bear market, the loop reverses, becoming violently negative and self-accelerating. As prices fall, redemptions spike, forcing mechanical selling, which drives prices lower still, triggering more redemptions. This is a downward spiral that traditional market circuit breakers are simply not designed to halt effectively, precisely because the selling is mandatory and non-discretionary. So, if the financialized system, the realm of indices, derivatives, ETFs, and paper promises, is destined for this catastrophic unwind, where do we turn? This is where the wisdom of Eric Sprott becomes not just relevant, but absolutely essential. The solution lies in stepping outside the paper cage entirely. The grand revelation, the ultimate countermeasure to the index fund collapse, is the return to real, tangible assets, specifically gold and silver. Why precious metals? Because they are the anti-bubble asset. They are the only financial assets that are not simultaneously someone else's liability. They are physical property, outside the fractional reserve banking system and outside the paper claims managed by centralized financial institutions. They are the antidote to excessive financialization. In a world drowning in index funds, where the only thing supporting asset prices is the continuous creation of debt and paper money, gold and silver act as a monetary hedge. They are money, not a yield-generating investment. Their function is not to produce cash flow, but to preserve purchasing power when faith in government-backed paper money, and the paper assets denominated in that money, finally cracks. When the index fund implosion occurs, two things will happen simultaneously. First, the nominal value of equities and bonds, measured in dollars, will collapse violently due to the liquidity vacuum. Second, the response of the central banks will be an unprecedented tidal wave of quantitative easing, money printing designed to stabilize the failing financial system, save the big banks, and prevent total economic depression. This is the great catch-22 for passive investors. The Fed's printing press, which might eventually prop up the nominal value of the remaining financial assets, will simultaneously destroy the real purchasing power of the dollar. The index funds might stabilize their nominal price after a devastating drop, but the value of the currency used to buy them will have been severely inflated away. Gold and silver thrive in this environment. They are scarce. They cannot be indexed, printed, or leveraged up infinitely by index funds. While there are paper proxies for gold, futures, gold ETFs like GLD, the true hedge lies in verifiable physical ownership. When the paper system fails, the only thing that matters is what you can physically possess, outside the electronic grid. Consider the dynamic. When panic hits, investors will flee index funds. Where do they go? Money market funds. Those are still paper claims on short-term debt. Sovereign bonds. Those are vulnerable to the currency debasement necessary to save the banking system. The only true escape hatch is the asset class that benefits directly from loss of confidence in fiat currency and financial complexity. That asset is physical precious metals. The development of this ultimate solution requires understanding the difference between paper gold and physical gold. Just as index funds are paper claims on stocks, many gold investment products are simply paper claims on gold held by custodians. In a true systemic crisis, the very crisis instigated by the index fund collapse, the viability of those paper claims must be questioned. Sprott's persistent focus has always been on maximizing exposure to the physical metal, held in segregated, audited storage, outside the major banking jurisdictions if possible. Furthermore, we must look at the mining sector. If the indices are toxic due to mandatory selling and physical metal is the ultimate safe haven, then the companies that pull the metal out of the ground, the well-managed, unhedged precious metal miners, become extremely compelling. They are leveraged to the rising price of the underlying commodity, which is itself soaring due to the flight from index-based paper assets. These companies, often smaller and less liquid, are precisely the kind of assets that index funds typically own only by necessity, in tiny amounts. Active, concentrated management, focused on deep value in this space, is the ultimate defense. The final payoff must be stark and unequivocal. Passive investing, while mathematically elegant in a bull market driven by QE, is a structural time bomb in a deleveraging environment. It promised diversification but delivered concentrated risk through centralized vehicles. It promised liquidity but created the conditions for a market-wide seizure. It is the greatest systemic flaw in modern financial architecture. The conclusion is simple. If you are relying on index funds for wealth preservation, you are relying on the continuation of a 15-year experiment that has defied historical precedent and common sense. You are relying on the belief that when the music stops, there will still be enough chairs for everyone who rushed onto the dance floor. We are entering a phase where financial survival depends on ownership of tangible assets and a complete rejection of financial complexity that cannot withstand a reversal of flow. The ultimate call to action is not to simply sell everything in panic, but to deliberately and methodically de-risk your portfolio away from the centralized index-based mechanisms. Transition capital into assets that possess intrinsic value, assets that cannot be replicated by a keystroke, and assets that benefit from the very systemic failure that index funds are designed to trigger. Review your exposure. Ask yourself what you truly own. And if the answer involves a passive wrapper that promises instant tradability in a panic, recognize that you may be holding the hot potato when the market finally throws it back at the crowd. This is the moment to prioritize verified ownership and the safety of scarcity over the false comfort of diversification through centralized index mandates. Move to the physical before the paper market locks up completely.